Hi, Dave Zagel here. Wanted to bring some more tax information to you. This is our third video in a series of videos on taxes, just to help educate people on where tax money comes from and why and how it's all structured. For this video, I want to focus on corporate taxes because we have questions about why aren't all businesses taxed as corporations. Before we get to that, though, I want to address one thing from our first video because we'll be referencing that video multiple times in this subject. One of the comments that came up from that video was when we looked at the percentage of the total revenue that corporation tax brings in, we talked about it being just over 6%, really 6.3% in the fiscal year 2018. And we used that as a reference point. And it was pointed out, a gentleman said, hey, you can't use that number. That's really just 1 year, and it was after the Tax Cuts and Jobs Act was passed. And I said, that's a fair point, absolutely fair point. What historically that rate has been, if we look here in our data set, that was 6.3% in 2018. We can see prior to that it ranged between 9 and 11%, with the exception, of course, of 2009, 2010, where it dropped below that, and even 2011 because of the recession. So fair point, absolutely. I wasn't trying to skew that percentage. The point in the first video was that corporation tax doesn't make up as much of the bigger piece of the pie as a lot of people might think. So again, I don't want to minimize corporate tax. Like I said in the initial video, it's just a matter of putting corporate tax in the perspective of everything. So historically, it has been a slightly higher percentage of the total tax revenue pie. Now with the Tax Cuts and Jobs Act, it is a little bit less. So one thing to point out, that was a very valid point. I just wanted to note, I wanted you to know that that was not the point I was trying to make in the initial video. So back to the corporate taxes and why aren't all businesses taxed as C corporations if tax rates are so low? I think there's a perception out there that with the Tax Cuts and Jobs Act, corporate taxes are so low that all businesses would want to be taxed as C corporations. And even though tax rates absolutely are the lowest that they've been in a very long time, it's still beneficial in most cases for the business to have its income run through the individual tax return. As we talked about in our first video, there are 4 ways for a business to be taxed. You can be a sole proprietor, a partnership, an S corporation, or a C corporation. A C corporation is the only type of company that pays its own taxes. And when we talk about corporate tax, in terms of this data, that is what we are referencing. Only the C corporations. All the S corp, partnership, sole proprietor, all of those tax structures flow through to the individual's tax return. So the question was, well, if C corporation rates are so low, why wouldn't all these businesses switch over to becoming C corporations to have that lower rate? The truth is, the C Corp, generally speaking, it's not in all cases, but in most cases, the C Corp tax structure still results in more taxes than having the business run through an individual tax return. When you own a C Corp, all the income gets taxed at the C Corp level. Plus, any money that you as the owner take out has to either come out as a dividend or as payroll. And there's different rules on how to do that. We're not going to get into the weeds on that. But just understand that if you're taking money out as a dividend, that gets taxed as well. So you've been taxed on the income once. As you take the money out, you get taxed a second time as a dividend. Or you can take it out through payroll. And in that case, the payroll is a deduction on the company, so it does reduce the net income on the company. But when you pull it out as payroll, you pay the individual income tax, And then you also pay the FICA taxes for Social Security and Medicare. And that, between the individual and the company, that tax alone is 15.3%. And you'd have your income tax that you pay on that salary, plus the C corporation still paying tax on the rest of the income that it earned. So that's why you don't see as many companies being taxed as a C corporation. A C corporation is more used when you need a complex equity structure or if you are a public company. And there are exceptions to that. There are some public companies that are not C corps, but by and large, most of them are C corporations just because of how they have to be owned. And again, not getting into the weeds on that. So instead of doing a C corporation, you can do an S corporation, partnership, or sole proprietor. And in those cases, all of the income is taxed at a personal level, either as you taking the money out or as self-employment or some mix of the two. But the point being, I'm hoping this helps you understand that, yes, C corporation rates, and really individual rates as well, are at some historic lows right now. But that doesn't mean that all businesses automatically shifted to being C corporation because it had some incredibly low rate. The individual tax rates are still much more beneficial than the C corporation in most cases. That's not 100%, but in most cases, that's the way it works out from a tax structure. So I hope this helps explain the C corporation and how it differs from the individual income tax. But that's really why we go back to that first video where we talked about where the federal tax money comes from. That's why such a heavy percent comes from the individual income tax, because even though there are businesses, most businesses still fall under the individual income tax rules. So if you have any questions on that, please reach out to me. You can send me an email, give me a call, whatever. I'm happy to help explain this, and just hope that people are getting a good understanding of the tax structure and where the money comes from and why and how.